Hello, I'm Crypto Sanity, and this is Crypto Gold Rush, where I teach you how to kill without even breaking a sweat. For you that are just joining, Crypto Gold Rush is a series of videos that will eventually come out. I'm getting sidetracked a little bit, but eventually it will come out and teach you how to become a super investor step by step. Now, when I say super investor, I mean being able to be even 90% of the pros over the long term. And when I say step by step, I mean from day one, if you're just getting started with a few hundred or a few $1,000s, all the way up to managing hundreds of millions. I've been at this game in one way or another for about 15 years in a variety of markets. And so I will be teaching you kind of timeless principles. Um, I actually don't really give a shit about crypto in many ways. It's nothing special in these principles that I'm going to teach, but it is the best game in town right now, and it's really a once in a lifetime opportunity if you know how to do it right. So I will be dropping in a link to introductory video where I was rambling quite a bit about what I would be providing in that, and then also another link to the first part of this series, which is specifically on ohm pricing. But before I get into that more, this video is the best way to rob a DAO is to own one. A masterclass in ohm model valuation. The reference of robbing a DAO is one that I took from Bill Black, who was one of the great financial prosecutors of the 80s and 90s who uh, really brought down a bunch of people in what was called the savings and loan scams. I'm not going to go into that much right now. However, they're basically a bunch of banks rugging people, and he put together all the evidence required to uh, get people behind bars. How does that relate to what we're about to talk about? Well, it relates in the way that DAOs, as they're currently constructed, kind of operate similar to these savings and loan scams, where there's an open treasury where a lot of people have access to it. And I'm not just talking about the devs, I'm also talking about quote unquote investors. And if you really understand the dynamics of how these savings and loan scams worked, basically all Ponzi schemes that then a few investors got very rich off of, and most people lost nothing or lost everything, then you can also understand how these Ohm Forks potentially could ruin you as well. That said, there's a big difference between the Ohm Forks and the savings and loan scams, which is that there's the protocol. And so what this video is going to talk about is how do you know what a good DAO is, scratch that, not what a good DAO is, what a good investment in a DAO is, and how can you play the market correctly so then that way you can be one of the people that walks off with a lot of money, hopefully with long-term success of these DAOs, rather than them turning into a permanently downward spiral, such as the savings and loan scam. I'm going to be going through uh, 101 on what Ohm is very, very quickly because I just made a video about this 2 or 3 days ago. And so if you have any questions, I really encourage you to check out that video. But I'm going to go through the initial bits of it in order to center us. I should have clicked on this next slide. Um, so yeah, so the first thing I'll talk about is just a very quick recap of how does anything have value, and then get into the Ohm model in particular. And then I'll be looking at the the more in-depth, how do you evaluate what the Ohm pricing more than just a one-on-one scenario that I talked about in my prior video. And then I'm going to do a very rapid fire look at crossworks. At the end of this video, if you're in any DAOs, then hopefully you will have at least the understanding to ask more questions. You know, maybe you won't feel that you fully understand it, and that's okay. Feel free to ask anything that you need. But it should, my intention, if I succeed, should give you enough understanding to be able to be intelligent about what your actions are. So let's get going. So I talked about this quite a bit in my last video, but basically for anything, you have value. What is the value that behind that? And basically the real quick recap is that everyone pays attention to the market cap, which is just the the price times the number of tokens. But what lies underneath that market cap are the assets and income, which make up the tangible part of that value, because these are the things that deal with, real actual money in some way. And then you have the premium. And the premium is basically just the speculative value over what could happen in the future. In this particular chart, what I have is I have an example of a project where there's a long time without anything tangible in it. And so all the value is a premium. And then it starts kicking in, getting going, starts bringing in income, starts bringing up assets. This is not what a Ohm fork would look like, because an Ohm fork from initially, immediately starts having assets. But this is more like if you're building a blockchain, like, you know, AVAX or Phantom or whatever your favorite one is. They spent many years in development and then all of a sudden started having something real, started having money come in. But I'm using this because it's a general model in order to evaluate what anything is. Now, is this always true? Yes, it is. I got Andre 3000 here to remind you of that. Really showing my age here, but there could be a few of you watching that this reference is older than you are, which is crazy, but it is forever true. So I'm going to keep repeating this over and over and over again because we lose sight of it in crypto. Okay, what I want to get into though is this is a new part I didn't talk about last time, which is the difference between value and growth investing. Now, in traditional markets, this is very well understood and uses the fundamental kind of grounding for what strategy do you want. But what's crazy about crypto so far is that everything has been so much about growth and so little about actual tangible value that no one even knows, no one even talks about value investing that much. So what is value investing? Well, the difference between value and growth investing is value investing is where you're dealing something very concrete. So in the example of this slide back here, value investment is you pay more attention to things that already have assets and income and have a very small premium, versus in growth investing, you're doing something that's speculative. You're going to be looking at things that have a lot of premium because they could grow, they could blow up and become enormously more valuable. Of course, they could also collapse and go to zero. The other part is value investing goes on continuation versus revolution in growth investing. By continuation, what I mean is that you're either looking at income flows and assets here and saying, they're going to keep growing at roughly the same rate that they have been, or even in this speculative premium part, you look at projects that have been delivering consistently, and you can see actually how that premium gets translated into tangibleness. And you can say, well, I think they're going to keep delivering on these new things, and so it's worthwhile to have a bit more premium on this because they will continue that. Whereas a revolutionary approach, you might be backing teams that don't have any track record, ideas that don't aren't proven, have no income. But if they work, then it's billions. And I already talked about this a little bit, but how these two things fit in together is concrete and continuation. They tend to go towards low premiums because people are investing based on what is proven, whereas growth with the speculative and revolutionary approach will have a high premium. The next part of this that is should be talked about by everyone, but isn't even talked about that much in normal capital markets, is what's called risk-adjusted returns. So here is not only do you have value investing versus growth investing, but what is the return that you can expect from those based on the amount of risk that you are taking. The value investing tends to be lower risk and lower returns, and it goes for a tortoise strategy of just consistent, boring returns over a long period of time, whereas the growth strategy tends to go for the hare strategy, where it tries to burst out of the gates when things are ready to have rapid valuation increases. Everyone talks about alpha. We all know what alpha is, but beta is the measurement of how much fluctuation does an asset have compared to the rest of the market. So if you have stable coins, obviously the beta should basically be zero. Whereas if you're investing in like speculative degen coins, then you might have very high alpha at some points, but you'll also have extreme beta. The trick to be a successful long-term investor, an actual investor, not just a gambler, is that you need to balance alpha and beta. If you're too risk averse, if you don't have enough alpha, then basically you're going to do okay for a while, but you're never going to be able to quit your day job unless you already have a bunch of money, etc. Um, if you have too much beta though, you might be way up at some points, but then overnight there could be a crash, particularly in crypto, and you just lose everything. So in order to be successful, you need to balance alpha and beta. And this is like literally going to be what my entire series is about. How do you balance alpha and beta at every part of your journey, and line that up with where the market is? And that comes into the last part, which is what are called tail risks, which are basically events that seem like they shouldn't happen very much, but when they do, then it's completely devastating. And crypto, we've seen Bitcoin fall 35% in a day. We've seen other coins fall 90% in a couple weeks. These would be considered tail risks because they're basically so extreme that you can't even calculate alpha and beta from them. You can't just say, oh yeah, I'm all good because, this is how it's been trending. And so I'm going to diversify a little bit and, you know, look at the charts and, uh, and I'll be good if there's a small downturn because there could be a complete catastrophic collapse at basically any moment. And so this goes beyond, tail risk goes beyond the alpha and beta even, and teaches you how to protect yourself. So that's another thing that I will be talking about much, much more in other videos. But I wanted to introduce these concepts because they're so important for these Ohm forks. Okay, so very, very quickly again, because I talk about this more in my past video, is this is how the Ohm model works. So basically you have price, and as long as the price is above the floor price, which most of them are setting to $1. In fact, I think the first one that doesn't set it to $1 is going to create some very interesting dynamics. But whatever the floor price is, as long as it's above, then it will keep inflating supply. And what the intention is, what the aim of the devs behind it is, they're trying to balance the price with how much treasury is there backing that price, and to keep growing the protocol. But eventually the price will go down to the floor price. Eventually. We don't know when that is, but it will eventually happen. If it goes below the floor price, then the treasury will start buying back in order to put it back to the floor price. But of course, that decreases the treasury and therefore the size of the protocol. Now, something that I talked about in my prior video is the floor price is $1. It's not when the market cap is below the treasury, which we're seeing now in protocols. We're seeing that now. And some people are asking, hey, I didn't think this was possible. Why isn't the treasury buying back? Well, it's not buying back because the token price is not below $1. So it's continuing to inflate. So this general dynamic, this is the underlying thing that you need to understand, and you need to master it. You need to get to the point where you have no questions about this dynamic, so you can actually pay attention to everything else. So check out my prior video. I talk a lot more about this. I talk about more misconceptions. Again, something I talked about in my prior video is the very basic way to value an ohm fork is you just look at the current price and the backing. So in this example, it's like a little bit greater than 2 to 1. And then you also look at the APY, which is in this case, it's inflating 24% a week. Now, something I want to make very clear is these people are calling these passive income. They're not passive income. There's no income that is flowing into here. So therefore, it can't be passive income. This is inflation. This is a psychological trick in order to keep growing the protocol, because as long as people don't sell, then the fact that you're inflating will increase the market cap value and incentivize, like, more people will jump in and grow the treasury because it looks like a good investment. However, now what we're seeing that the treasuries are starting to stagnate. We're starting to see that prices are starting to collapse in these Ohm forks. And therefore, these returns, they're not returns. They are inflation. So this is actually, if all else is equal, if it cannot continue pulling money into the protocol, this is the amount that you could expect to lose over 5 days. So I want to make that very clear. the because this is underpinning all of the valuation, and is basically what makes this, a Ponzi scheme in some sense. The rest of the video, I'm going to get into more advanced valuation than just this, because what I'm going to show is it's much more complicated than just looking at the treasury and the current Jade price, or the current token price. So the treasury value, it's a trap. What you see on the front screen, and you see this is how much our treasury is worth, you can't go just by that number. You actually have to look at what are the assets. And there's a few different places here where you have to be really careful. One is the network natives. So a lot of these protocols love being very heavy in whatever network they're on, AVAX, Ethereum, whatever. But the other thing that you have to look at is the impermanent loss in the LPs. So like I was saying here, eventually the price of the token should go to $1. Well, what happens when the price of an asset in LP falls a lot? You start getting massive impermanent loss, and you start seeing, you know, therefore the LP is going to lose the vast, vast majority of its value, like greater than 99%, right? And so that's something that I want to talk about as well. And then the last part is hidden leverage. So some of these protocols, you actually can't go by just by how much is in their treasury, because even if it looks stable, it's not necessarily stable. And I will talk about why as well. All three of these things, the rest of this is really why I'm calling this a masterclass in valuation, because if you can understand these parts of it, then you're going to be able to quickly look at any fork and get an idea for what its tangible value is. It won't tell you what its intangible value is, i.e., how much future growth potential there could be based on the purpose of the protocol, but it will tell you its tangible value. And like I said, going back to here, this is going to teach you how to take a value investing approach. The growth investing is what could happen in the future if the protocol succeeds and they redeploy the treasury in whatever way they say it's going to. But these numbers I'm about to give, this is the value approach. Okay, so this is Olympus DAO. And the first thing I wanted to look here is you really have to pay attention to how much of the treasury is in the network natives. Why? Well, what happens when there's the next bear market and the network native goes down a lot in price? What would happen if Ethereum dropped 50% or 75% or 80%? It's happened several times in the past, and it will probably happen again in the future. In fact, I think we're at the very beginning of what could be an extended bull market or a bear market that will pull down major token valuations even to at least 50% losses, if not 75 or 80% losses. That's just my opinion. I think it's a well-informed opinion. I'm going to talk about that in other videos, but from a risk-adjusted approach, from a valuation approach, it doesn't matter whether you think it's going to happen or not for the intents of this video, because the way that I'm going to propose that we invest into these Ohm Forks is from a risk valuation perspective. So we need to say, assume that Ethereum goes down 50, 70, 80%. Okay. So what would happen if that did happen? Well, look at their treasury. Now I'm trying to get some better numbers here, but because if you add up these purchase numbers, they're not anywhere close to this treasury balance, and I don't know exactly why. I can speculate why. I don't know exactly why. I've actually tweeted at their team to try to get me numbers of why there's such a big discrepancy. But what you can see here is you can see that 40 million is in Ethereum directly, and 122 million is in the LP, meaning that there's $60 million of Ethereum value here. So that's $100 million of Ethereum. And by contrast, there's only $100 million of stables. So if Ethereum collapses, goes down by 80%, we can expect that the treasury would go down by 40%. I'm not going to do that math, but that's the right answer. um, but yeah, I'll just say it real quick. Because the Ethereum is making up 50% of the whole thing, and if it went down by 80%, then you have to multiply 50 million by 0.2, which is 10 million. And then there's right. Sorry, I was doing this, treating this as a okay. I'm uh okay. I got off my flow. It would go down 40%. However, there's also there's just gigantic treasury balance that I don't know where this comes from. Like a huge percentage of this could come from the increased price in Ethereum since it was bought. They might have sold some of that. I don't know. On their front page, they claim that they have like tons of DAI in their treasury and little ETH. But I don't know. Let's say that let's say they didn't sell any of the ETH to DAI and they just let all of this grow, then you know then you would have a huge amount that's not in stables. And so again, if Ethereum collapsed, then you would have a huge collapse in your treasury. So that's one thing that you have to look about and think about in evaluating the treasury. The second part is the LP price. So I'm using Wonderland here as an example, time, because look at this. Look at how much of their treasury is in their time LP. You have 450 million, and they're only showing 173 million that's not in that. Well, as we talked about, the price of time should, over time, no pun intended, go down towards one, or it could go down towards one. And so what that would do is that would cause an enormous amount of impermanent loss and basically wipe out the vast majority of their entire treasury balance. Now, I don't actually know that much about time, so there might be some mechanisms in here that would prevent that, or future plans. It might be a growth play. I don't know. I'm not saying it definitely will go down to one. I'm just saying that based on the pure value investing approach, that most of the treasury here is at great risk when the price of time falls. And time has fallen over 50% over the last few weeks, and so this would have eaten a lot into these LPs, and they have very little comparatively that's not in the LP. The last thing to pay attention to in these treasuries are hidden leverage. Now, this is a more complex topic that, again, I will need to get into in other videos, but a lot of this time stuff, include this time MIM LP and even this MIM LP. Well, what are MIMs? MIMs are actually a stable coin derivative, I would say, meaning something that represents something else, but it's borrowed into existence. And if you look at the where a lot of the MIMs come from, if you go onto Abracadabra, where you actually create them, you'll see that there's 100 million MIMs out there that have been created with staked time. So what people are doing is that they buy time, and then they stake it and wrap it and create this wrapped memo, and then they borrow off of it, and then they use that money to buy more time, and then they repeat. So what this does is that this created an amount of leverage where, as the time price falls, people are going to start getting liquidated, and they are going to basically need to exit their positions, which could, um, basically cause the time price to fall further. Now, what this means is out of this 445 million, there could be a significant percentage of that isn't actually representative of organic growth of the protocol, but is instead a leveraged position. I don't know what that amount is. There is so much leverage in crypto in general that this is a huge risk for those tail events that I was talking about where everything just falls apart. But it is something to definitely pay attention to and just be aware that that's a possibility. Again, I'm not saying that there could be a massive that there will be a massive deleveraging event. I'm saying that there could be. So when you're evaluating these as a risk play, it is something to keep in mind. Okay, so far I've been talking all about the tangible value. There you have the intangible value as well, which is the speculation of the growth in the future. And so this is really what distinguishes the Ohm Forks apart, not just the numbers that I've briefly shown, but also the intention for the fork. So Ohm is saying that they're starting to call themselves Bretton Woods 2, which is a super geeky um, reference point. Um, but basically, all it means is that they're trying to become like the standard for how currency is used in crypto, and so they are basically trying to become the fundamental unit of value transfer, and they have all this economic theory on what that means. Not going to go into it, other than if they could pull it off, it could make enormously valuable, just for that reason. There's also Jade, which they are talking about as a VC fund of funding basically a launch pad. Again, that could, of course, become enormously valuable if that worked. Papa is talking about being the coin for metaverse and gaming. Uh, I don't know too much about this one, but again, I assume making investments somehow. Time has the Frog Nation, and putting together all of these pieces, including how does it grow abracadabra, et cetera, et cetera, et cetera. And so there is long-term network value there. And then Rome and a few other ones, they are really trying to create um, LP and like dominate the amount of liquidity that are if the dexes on their network, um, will be providing them a lot of fees. Other ones, I could keep going on and on. At this point, basically all Ohm Forks need to have some sort of intangible value story. Um, Whether any of these or which one of them will play out, is up to you as an investor to decide. But it is definitely what gives the reason. It is literally the reason for existence of these things. Um, and so it is something to like you definitely have to keep it in mind when you're looking at whether to invest or not and what the proper multiples are. Okay, I know that I've thrown a lot of information out very, very quickly. I've done this on purpose, and uh, to kind of start a conversation, whether they're trying to explain the nuances of everything. I'm hoping that this style for people that are more sophisticated and know more what's going on, that the rapidity of this will just make a couple of things click. For everyone else, if you've been investing in these things or thinking about investing, and you're just looking for a more basic understanding, I hope that just dumping on this information has at least affirmed what you already know and maybe made some um, questions that you realize that you have gaps in your knowledge, and so then that way you can ask those ask questions to fill those gaps. The rest of this video is just going to be really quick fire, looking at a few DAOs and using this valuation approach. I'm not going to really talk that much about the intangible value. A lot of these ones I don't actually even know what that is, or if I know it, I don't know how much to believe in it. But we can use the general valuation um, uh, in order to compare them on the tangible, relatively speaking, on tangible grounds. So there's this amazing account from BlueDex, and what they are doing is they are basically tracking all these DAOs and looking at the tangible amounts, um, and keeping this pretty much up to date. And so this is a great account. They've written great articles on this. I'll be linking to that. I really encourage you all to follow and keep track of these things, because it's the easiest way to understand how your investments are doing, or uh, potential new investments. And as you can see here, this is really the 101 level, which is what is the market cap, what's the treasury value, what is the market cap to treasury value ratio, and then they have this risk-free value, which I should have talked about before but forgot. The risk-free value is, remember how I was saying that the treasury value can go down for all sorts of reasons, like being network natives or LP wallet loss or whatever. The risk-free value is, what if everything that goes to zero? What if everything goes to zero that can't go to zero, and all you're left with is the stables? And so this is like your absolute worst case scenario. And so what this chart shows is, this chart shows that the market cap to treasury ratio, and then the market cap to risk-free ratio. What this kind of tells us is, if the number is below 1, and the treasury maintains itself from here on out, then you're guaranteed to make money. If you hold long enough, you're guaranteed to make money. If the market cap ever falls below the risk-free value, well, then you're 100% guaranteed to make money, because all you have to do is hold and sell emissions. And so what this does is, this single spreadsheet allows us to look on a value investing 101 in potential DAOs that we could go into. So for the rest of this, I'm just going to go really, really quick through these DAOs that I've highlighted. That way, if you're in them, hopefully you can see oh yeah, I've got it. And if you don't got it, then just hit me up somehow and ask questions. Okay, so the first one we have is PapaDAO. So if you look at PapaDAO, their price is below the backing. So again, as long as the treasury holds, you're guaranteed to make money in PapaDAO. If you look at their actual, what is in their treasury, they have a lot here in stables, and they have a relatively little in this Papa Min LP. So, this is looking pretty good. It's like AVAX is quite a small percentage here. And so if AVAX collapses, don't have to worry about that too much. They have a low price, and their LP is pretty small compared to their stables. So again, even as their price decreases, you're not going to get much hit to your treasury. So not only is the price below the current treasury value, it's not that much above the risk-free value. Now, what does that mean? Well, on the flip side, there's not really much room for growth in this treasury either, not directly. You know, let's say AVAX like 4x, you would barely even notice. Um, so clearly, Papa isn't planning on making value from the DAO from what they're holding in the treasury, and because they're saying they're positioning themselves to do gaming and metaverse stuff, what I assume that means is they'll be doing direct investments, and that's why they're focusing mostly on getting stables, because if you're an investment fund, you want to have a stable amount to invest into things. And so what I would say is Papa has it has, from a risk perspective, it has low risk. From a value perspective, it might not actually have that much value either, because uh, because it's not going to grow very much. Now if the Papa price collapsed, like if people panic and they like sell off, then it would be like an amazing value play just to get back to, you know, the treasury. Uh, and but it's a great speculation play. It's an amazing speculation play because if they succeed in their games, then um, it could be worth a lot. So if you believe in the team and the purpose of that, then because there is pretty low risk here, it's a I would say it's a pretty good bet. Also, I should make a disclaimer here. None of these things other than Spartacus do I have any money in. Um, I might put money in them later, but I'm not front running you guys. So um, so that's it. Okay, so Spartacus, which is the one that I am in, um, Spartacus, their price is quite below Treasury. If you look at this, if you look at their actual Treasury again, you have a relatively small amount in the network native token. So there's not very much risk there. Again, not very much reward. You have a ton of DAI, and then you have this relatively sizable LP. So again, with Spartacus, the the risk uh, the risk is there in just that people will like keep selling the Spartacus token because they don't believe in long term stability of the platform and long term potential of the platform. But it doesn't have very much risk outside of that. And so if 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 they can get if there is long term value in the vision here, then again it's a quite good play from a growth perspective, um, with relatively low risk, and that's why I have some money in here. Um, I will see how it goes, uh, and go from there. Then you have Fortress. I don't know very much about Fort, but if you look at here, it's almost 1-to-1 between what's in the treasury and their current price. If you look at this though, it's like super heavy in in stables. Look at this, 12.7 million in MIM and barely anything in AVAX, and then you have uh, you know a pretty small percent in the LP. So once again, it's pretty close to the risk-free value, particularly because the token price isn't that much. And I just reading very briefly, in their white paper, they're planning to invest this into things. So again, another one to check out. It's all about the narrative of what they're going to do with the treasury. Okay, moving on to Hector. Hector's interesting because they have a lot more different assets, but the assets are all kind of mostly boring in the sense that look at this, they're almost all stables. So again, you have the price pretty close to the backing price, and mostly here in stables, almost all in stables actually. Fathom's basically nothing. So again, this is what are they going to do with the treasury? And again, a long-term play. I don't actually even know what the long-term play is for Hector, but that's what it is. Squid on Ethereum, I don't know anything about Squid, and their website wasn't working. So, but a few people that I trust, they think that Squid is like has amazing potential. So check that out. Okay, so now to time. Now time is here's where we start getting to something that's more interesting. Um, you see here that the time price is double what the treasury backing is, and even as of like 2 or 3 weeks ago, they'd be like, oh, that's on fire sale. But like in the last few weeks, like everything's gotten sold off so hard that it's now kind of middle of the pack, just being double. If you look at this though, they have a huge chunk in AVAX. They have quite a lot in AVAX. So if we are going into a bull market, there is exposure there. And then for the other things that I already talked about in terms of like potentially hidden leverage and the LP impermanent loss, they are there is quite a lot of risk in there. So what I would probably say on time is it is much, much riskier, or I should say it has much less value than the ones that we've looked at so far. Now, if the treasury it has um, a 1.4 billion dollars in, no, it's $713 million in treasury, so it has a huge treasury, you know, uh, 10 times what the other ones have. And so how they deploy that, it could be amazing growth in the future. So I'm not saying it's bad from any um, stretch of the imagination. Everyone I've talked to um, has said, really keen on it. But what I am saying is that as a value investor and thinking about how do I protect my portfolio in a bear turn while also like aiming for the upside, time would not be my first choice in that. I would wait to see how much it gets hit. Um, then we have Jade. On one level, who knows what the hell's going on with Jade? It has this whole complication behind it. But on another level, like it right now, it has more than 3x in the market cap to treasury balance, which again, even a few weeks ago wasn't that bad, but now it's starting to look pretty pricey. It has a decent exposure to Binance, and so in a bear market, that's an issue. And then you also have uh, quite a lot in their LP. Um, so again, this is relatively speaking, not as it has more risk. Um, they also have this like huge inflation rate. I'm not going to call it ROI. They have this huge inflation rate, and so what this means is that if the protocol growth slows, then all this could get eaten up really fast, like really fast. And so it Jade might be a good value in terms of growth, but uh, they just go with like all guns blazing, like 100%. And so if they can't keep up the momentum, then what already looks like kind of like yeah, sort of valuation, it could get worse, much worse, much very quickly. Then we have the OG of Ohm, um, also Olympus is what it's actually called. Olympus has a very high price compared to its backing. I'm not even talking about the risk-free value, just like the treasury backing. And so again, from the value perspective, not very good value. This is all a bet on what can they do with the protocol and can they pull that off. So I hope by this point, like just looking at these numbers and the framing that I've been saying from a portfolio diversification play, like a risk play, you know, Ohm actually isn't looking too good in my opinion on just these numbers. And then finally you have Rome, which is like I love Rome's vision and professionalism and in the branding and all that. I was so excited to watch Rome come out, but it is a terrible investment. Like there is no possible way. Like the the amount, which they don't even show this on their website, to, first of all, but if you look at how many Rome are staked, which isn't even how many Rome exist. They have $115 million market cap right now, but they only have 12.8 million bonded. So that's a 9x ratio that blows everything else out of the water. They have decently high inflation, so it's still a young protocol. And so what this means is if the protocol doesn't grow, at this rate, then even this modest treasury will get eaten quickly. And then if you look at this, they have the majority of their assets in their LP, in their own LP. And so as the price falls, that's going to eat up their treasury very quickly. And so you pretty much, the risk-free value ratio is even worse. So not only does it have the worst like treasury ratio, but it has like astronomically worse risk-free ratio. So Rome is everyone, all the other ones, you can spin me a story that it could still be an investment, a good investment right now if something happens quickly. But Rome, there's no possible way. Like no one could ever convince me that this was a great investment, um, based on their current valuation. I would want to see them drop in price to like, I don't know, 70%, 80% losses, and then I would think about it. And I actually went into their Discord and I tried to like explain this to them, why they needed to be getting in more stables and other stuff, and that everyone needed to take a haircut. Um, but no, they don't want to do that. So they're going to get haircut eventually. Rome could end up becoming a great long-term protocol. Again, I'm not saying any of these long-term are bad or good. I'm just saying from a value perspective, like it's terrible. Um, so the summary is hype season and these things are over. You're no longer seeing like this massive growth. You're no longer seeing huge influxes into the protocol. So that means we need to look for value, either the tangible value or the non-tangible value of how they're going to use the treasury. Because it's no longer just throw up a fork and you instantly become rich. What are you actually doing with it? And the last part to this is that if you find DAOs with great value in them, the combination of tangible and non-tangible, then if you enter them at the right price, they are amazing for diversifying your portfolio because they can protect you against volatility in the market where everything else could fall 70, 80%. And you know for a fact, for an absolute fact, that you are protected in these protocols while still having lots of potential upside. So it is an amazing what they call counter-cyclical option. And I would encourage everyone that's listening to this to learn more about Ohm models and start getting to the point where you feel comfortable putting a relatively significant percentage of your portfolio into these. Not financial advice, obviously, but that's definitely what I'm doing, or will be doing. I'm not quite doing it yet because I think there's still quite a long way to fall, and definitely don't bet the farm, or anything can go to zero. So um, so don't put so much in that you would lose sleep at night if you lost everything in it. But from an investment point of view, like at this part where we are in the cycle, it has enormous potential. And so I want to this is the last thing I want to present. There is this thing called the hype cycle. And so basically as things start being, proven, then everyone is like, "Oh, this is just printing money. It's magic." And then you have this massive run up, and no matter, you can just throw money into anything and make bank like pretty much instantly. But then when it gets too rich compared to what it's actually delivering, and once the money stops flowing in at the same rate, then the bubble starts bursting, and then you get this huge decline. And they call this the trough of disillusionment. We're somewhere we're somewhere in here right now. I don't know where we are. I don't know if I'm not saying we're at bottom. We're somewhere in here, and everyone's like, "Oh, that thing didn't work. That thing is terrible." And most people will move on. The vast majority of people will move on. They'll never think about it again. The ones that stick through and they find the actual value in it, they actually put together, "Oh no, this is how you use it. This is the proper way to use it. It's not just throwing a bunch of money at things." Then eventually they will rebuild, and you get into this um, rapid growth again, which is pretty similar to the peak of rapid growth in the beginning. However, it will curve off, it will flatten. It will never get to the hype that it had before, but it will actually be useful. And what value investors look for is value investors look for opportunities that are near the trough. Because if they can get a bunch of investment into things that are proven, where they can see what the model is, but they can get them at massive discounts, if they can buy things that the market hates, then by the time that the market realizes, "Oh, wait, there's actually a lot of value here," then not only can value investors make a lot of money when it goes back up, but they have very low risk in doing so. And the greatest, most prominent investor of all time, Warren Buffett, he is 100% a value investor. He basically never makes any investments based off of speculation or growth of what can be. He looks at blue chip industries, blue chip companies, some of them which have been around dozens or even, or decades or even centuries, and he waits until people hate them for some reason, and then he buys them. He puts in a team that turns them around, and then makes bank with very low risk. And that's how he's had returns that kill the market for decade after decade. If you can learn to become a great value investor in addition to being a degen risk taker, then you are going to be able to beat the market consistently, no matter what it's doing. And you're going to put almost every single pro to shame. So that's a little pitch for the rest of my series. Um, I am not a Warren Buffett. I do not have I do not do primarily value investing. I switch between my investing styles based on what where we are in the market cycle. But for the ohms, I'm seeing an amazing opportunity here, and so I encourage you all to really take in what I've said here. Watch my prior video and ask any questions. You might find that value investing is not for you, but I really encourage you to all give it a shot. All right, that's it, and thanks.